Okay, welcome in. This video, we're going to be talking about hedging, which is a very popular strategy. I don't know if it's quite a strategy, but very popular technique in finance, and how you can actually look at hedging in your own personal analysis, data science in our setup. So I'm loading two libraries that will be important here. We've talked about QuantMod in a previous video. Allows us to get stock information for a wide variety of stocks. And then this performance analytics package, which is really nice because it does a lot of cool financial analysis that we're going to see. But first, we do our awesome, I'm going to make this a little bit bigger, get symbols function. And what this does is it loads an object called AAPL, which is the stock ticker for Apple, in our environment. So if I type head AAPL, it's going to show me the open, the high, the low, the close, etc. for the stock, going back to 2007. And you can see when I'm making this video, it's late July 2022, and we have the most up-to-date data. So pretty cool stuff. I can do the same thing for GLD, and GLD is gold. So I don't know if it's an ETF or something, but it tracks the price of gold. Now, what's cool about gold is that it's traditionally called a flight to security flight to safety or security type asset. The idea is when the market is not doing well, people may sell their stocks that are underperforming and go and buy gold because it's a hard, it's an actual thing. It has value. You have a gold bar. It might be a better way to, have your savings and money in that versus a stock that's plummeting, right? Just like some valuation on some piece of paper. So traditionally, gold is negatively correlated with other called risk-on assets like Apple, other types of stocks. It's going to be our hedge in this example. So the first thing I want to do is match the dates of our gold object and our Apple object. We saw that our Apple object started in January 3rd, 2007, but gold is much, maybe I already did this, but gold really we have going back to 2000. But what I do here is I just do a quick little index. Index gives us the dates since these are time series objects. It gives us the dates of the objects, and this is just making sure that the dates are the same. So I kind of restrict gold, and now they have the same number of rows, which means they have kind of the same days. And a quick check to see if the date of gold is the same as the date of Apple all the way across. So I take the average, and 100% of the time it's the same. So it's always the same. So now we can actually build our portfolio. I'm going to start with W equals 1. This W is the weight that we're going to put into Apple. So imagine you have $100. You could have $1 million, $500, $25, whatever. You're going to put 100% into Apple and 1 minus 100% or 0% into gold. And that's what we do when we create this portfolio, which is taking the closing price of Apple times the weight, and then whatever's left in gold, which in this case is going to be 0. So here we create our portfolio, and now we have a portfolio which is just a kind of combination of Apple and gold. In this case, it's just Apple, and I can calculate the return of that portfolio by dividing the return by 1 day previously lagged. So basically today's value divided by yesterday's value, subtract 1 to get the return. If the stock doubled, and then we divide it, right, then we're going to get 100% return. The stock doubled. I'm going to take out the first value in return because it's going to be NA, because we don't have anything to divide it by before the first day. So now I have this nice return object, and this gives us daily returns. So the return for this specific day is 3 places to left, so a little bit less than 1%. In this case, it looks like. Awesome. And we can actually see like what that return looks like just by plotting the cumulative sum of the return. I need to make this bigger, and I will do that. And we can see this is pretty good, right? We start out at 0. We have 0% return, just flat. And we climb all the way up. This is to 400% return. So, unsurprisingly, if you bought Apple in this time, it was a good bet. And if we plot Apple itself, we want to plot the Apple close. You can see that the stock roughly quadrupled. We roughly have the 400% return that we're seeing in this cumulative sum or cumulative return. Over 400%, really almost 500%. We can also look at the volatility. So I'm going to look at the standard deviation of the return. In this case, that's 2.03%. And kind of as you know, what we're going to be talking about, stocks have a risk-reward trade-off, risk-return trade-off. We want to have a lot of return, but we don't want to be exposed to a lot of risk while doing it. So anytime we can kind of jack up our return while lowering down our risk is a good thing. Okay, so that's when we have 100% Apple. What about when we split the portfolio, half in Apple, half in gold? So we do the same calculation here. We redefine the portfolio 50-50 in both. We define the return, and then we plot the cumulative return. And here, unsurprisingly, the chart looks a little bit similar in shape, but it only goes up to, just under 200%. So we get way less return when we put half our portfolio in gold. The trade-off, though, is that if you remember, the volatility of just Apple was over 2%. Here it's 1.07%. So half the volatility. So, here's a case where we're getting less return. The return is not that high, but the volatility is also not that high. And that could be good. You might want that, right? You might want a lower volatility portfolio instead of a volatility with a really jacked up return and a really high volatility. So the way we're going to do that, the way we're going to measure that is with a Sharpe ratio, which we may talk about in another video. The Sharpe ratio, the simple idea is just the return divided by the risk. Type that out clearer. And again, this is kind of thought of as risk-adjusted return. You might have a huge return, but if you have a really, really high risk, it might not be an investment you want, because even though the expected return, and this return is expected return, even though the expected return is great, you're exposed to a ton of risk, so things could go badly. So the idea with the Sharpe ratio is you want it to be large because you want expected return to be large, and you want, the expected risk to be small. So what we're going to go ahead and do is run a loop, and this code is kind of the same code as above, but we're going to be iterating over different weights. So we're going to say, I go from 0% in Apple all the way to 100%, and I'm going to change, by 10% each time. This portfolio has 30% in Apple and 70% in gold. And then, apologies. Sorry, I watched that. I was talking to it. And then for each loop, we're going to take the Sharpe ratio with the Sharpe ratio annualized function. That's from the performance analytics package that I talked about earlier of our return object. Okay, so let's go ahead and do that. Going to take a little bit of a while to run because it takes some time to calculate, and we got it. And I'm going to organize that into a plot and run some ggplot to show it, and voila. We have the Sharpe ratio on the y-axis, and remember, we want a high positive Sharpe ratio because that means a high expected return for low expected risk. And on the x-axis, there's the percent we invested in Apple. So you can see that generally it's better to have more invested in Apple. That makes sense. Apple has done extremely well. It's a big success story. It has a lot of risk, but it has a lot of return. However, the highest Sharpe ratio here is when we have 90% invested in Apple. And, again, that's going to have a low 90% invested in Apple and 10% in gold. That's going to have a lower expected return than 100% invested in Apple. However, the risk, right, the total risk of the portfolio is low enough that it offsets that loss of return and actually means it's a better risk-reward trade-off. And that's kind of what the Sharpe ratio captures. We can play with this a little more by, let's say we went to 120% Apple, which means we're actually shorting, gold 20%, and see what the risk will be. That actually might not make sense. Yeah. Sorry, that's not going to make sense. But another thing so ignore that. Another thing we can do is we can zoom in from, the area of interest from 90% or we'll go from 85% to 95%, and we can look by smaller increments and see like exactly where that Sharpe ratio is maximized, because in the current chart it's a little bit crude. So here it looks like we went from, let's try. Here it looks like it's increasing all the way up to 95%. So let's try around the 90%. Yeah. And it looks like 95% is the answer. So we get the Sharpe ratio increasing, and then at 95% maximal, and then it kind of falls off from there. So hopefully this kind of makes sense. Oh, yeah. And I mean, it's good that we looked at this, right? Because in this chart over here, it told us that 90% was optimal. But really, when you break it down from 90 to 100, 95% is the best one to go. And that kind of makes sense, right? Like Apple has done super, super well. It would be surprising if you had a low percentage in Apple, but it does help to have a little bit of the hedge. And again, the hedge, the idea is it moves in a different direction as Apple. Like if we look at If we look at Apple, I keep forgetting to do the close. If we look at Apple, it has some periods where it's down, right? This in 2019, it's down significantly. In 2016, it's mostly flat. And the idea is that gold is going to help offset that. So, in 2019, it has a little bit more of a rise. In 2016, it's a little bit more positive. So that's the idea with the hedge is you invest a little bit to offset it. And even though you might reduce your expected return, you're improving your risk reward trade-off. So hopefully that made sense, and we'll see you in the next video.